Stop whatever you're doing right now. Immediately. I don't care if you're at work, close that Excel file. No one gives a damn about your quarterly numbers. If you're at the gym, drop the dumbbells. Your arms will be fine. If you're somehow walking your goldfish, put it back in the bowl. Fish absolutely do not need walks. This matters more than anything you think you're doing right now. And if you own silver of any kind, physical bars, SLV, COMEX contracts, mining shares, collectibles, anything at all, do not look at your portfolio until you finish watching this. You must understand the full picture before you react. Are we clear? Good. Pay attention. Ladies and gentlemen, it's me. Today is Friday, January 16th. Launsenling Archelou. And at 2 a.m. Eastern Time, the Chicago Mercantile Exchange released data I have never encountered in my entire career tracking the silver market. Data that should not be possible under normal mathematical constraints. Data that proves the paper silver market isn't merely under pressure or running tight, but is instead catastrophically and permanently broken. I'm going to walk you through exactly what happened. Back it up with numbers. You can verify yourself and explain why this marks the beginning of the end for paper silver. So lock in, eliminate distractions, to silence your notifications. Because what you're about to hear will fundamentally change how you understand COMEX, silver, and what's likely to unfold over the next 30 days. Before we go further, a quick note for those who want more than surface-level commentary. I've prepared a concise educational guide that breaks down the warning signals inside the physical silver market that appear before major repricing events, things like COMEX inventory movements, futures curve distortions, delivery strain, and shifts in government policy. This is the same analytical framework I use to interpret developments like this. And it's available now through the link in the description. Let's begin with the numbers, because numbers don't lie. Politicians lie. Wall Street lies. The mainstream media lies. Mathematics, however, is objective reality. Today, January 16th, Launsenling Archelou, was first notice day for the February COMEX silver contract. First notice day is when long holders of silver futures must officially declare whether they intend to take delivery. In other words, they tell the exchange, I want the metal, not a cash payout. In a healthy market, most traders never do this. They're speculators, trading price movements, not seeking physical silver. That's how the system is supposed to function. Yet in January 2026, which is not even considered a major delivery month, we already saw 690 contracts stand for delivery. That alone was abnormal. It was already flashing a warning signal. But today, in February, a primary delivery month, the figure reported at 2 a.m. exploded to 47012 contracts demanding delivery. Let me repeat that so the scale truly sinks in. 47,012 contracts. Each single contract represents 5,000 ounces of silver. Multiply that out, and you get 235060000 ounces. In plain terms, the market is demanding roughly 235 million ounces of physical silver for February delivery alone, a figure that defies any reasonable expectation of balance. Now let's look at the supply side of the equation. The exchange releases daily warehouse reports that detail registered inventory. Registered inventory is silver that has been officially approved and set aside to meet delivery obligations for expiring contracts. According to the most recent report, dated Tuesday, January 14th, registered silver inventory stood at just 23, 1 million ounces. Read that carefully, 23. 1 million ounces available versus 235 million ounces demanded. That's a ratio of 10. Due to uno, this is not merely a tight market. This is not a classic supply crunch. This is a mathematical impossibility. There is no scenario in which 235 million ounces can be delivered when only 23 million exist in registered form. The system has failed. And to grasp just how extreme this situation is, we need historical perspective. Over the past decade, a typical February delivery month has averaged around 9,000 contracts standing for delivery. Some years come in lower at 7,000, others slightly higher at 1,2,0,0,0, but the long-term average remains close to 9,000. 9,000 contracts multiplied by 5,000 ounces equals 45 million ounces of demand. During those same February periods, registered inventory has historically ranged between 80 and 120 million ounces. That means roughly 45 million ounces demanded against about 100 million ounces available. A demand-to-supply ratio of 0. 45 to 1. Stable. Manageable. Normal. Compare that to today. We now have 235 million ounces demanded against just 23 million ounces available. That's a 10. Due to N ratio. This isn't double the norm. It isn't 5 times worse. It's 23 times more extreme than historical averages. Let that sink in. Today's imbalance is 23 times worse than designed. If you plotted this on a chart, it wouldn't even fit. It would sit completely off the scale. And remember, this is happening on first notice day, which means the exchange has from now until the end of February to somehow deliver 235 million ounces with only 23 million on hand. So how do they do it? They can't. The system has now hit its breaking point. Every participant in the silver market, from the largest bullion banks to the smallest retail traders, saw this data hit the screen at 2 a.m. today. And they're all asking the exact same question: what happens next? To answer that, you need to understand why this situation cannot resolve itself and why the mechanisms that normally restore balance are failing completely. In a healthy market, excess demand is solved through higher prices. When demand outpaces supply, prices rise until supply increases or demand cools off. That's basic. Economics 101. So with 235 million ounces being demanded and only 23 million ounces available for delivery, prices should rise enough to convince some longs to accept cash settlement instead of metal, or persuade owners of eligible silver to convert it into registered inventory and make it deliverable. That's how the system is meant to self-correct. But here's the reality: it isn't happening. Since January 1st. The price of silver has already climbed from $85 to $91. That's a roughly 7% move in just 2 weeks. And instead of easing, demand intensified. A staggering 4,7,000 contracts stood for delivery. The largest February delivery demand ever recorded. Rising prices are not discouraging buyers. That's because the entities standing for delivery are not short-term traders. They aren't retail speculators who flinch at volatility. These are industrial consumers who need physical silver to keep production lines running. They include manufacturers, sovereign reserve managers, and highly sophisticated institutions that understand paper silver is abundant, while physical silver is not. For them, whether silver costs $91, $1 or $120 is irrelevant. They need the metal itself. Demand, in this case, is inelastic. Price increases do not reduce it. So why isn't supply responding? Why aren't holders of eligible inventory stepping in and converting their metal to registered status? The answer is trust, or rather, the lack of it. Eligible inventory is silver stored in exchange warehouses that belongs to private owners but has not been offered for delivery. It sits there for convenience, not obligation. Once that silver is converted to registered, it becomes fair game to satisfy delivery demands. And that's where the risk lies. In a shortage environment, once registered silver is assigned and delivered, it's gone. The original owner may never be able to replace it. Knowing this, eligible inventory holders are refusing to convert. Their stance is simple: my silver is mine, and I'm not handing it over to rescue short positions. The result is paralysis. Over the past 2 weeks, only about 3 million ounces have moved from eligible to registered status. 3 million ounces is negligible. It barely scratches a 212 million ounce deficit. This means the market's normal pressure valves are no longer functioning. Higher prices aren't destroying demand. Inventory conversions aren't unlocking supply. The system is frozen in place. Demand is rigid. Supply is locked. And the imbalance between the two isn't shrinking, it's becoming impossible to ignore. And that gap is still growing. Now I want to explain why arbitrage has completely collapsed, because this is the most critical concept you need to grasp to understand what's unfolding. In a normal commodity market, shortages are resolved through arbitrage. When one region runs short and another has excess supply, traders buy where metal is available and ship it to where it's needed, restoring balance. If New York is short and Shanghai has surplus, traders purchase in Shanghai, move the metal to New York, sell it at a higher price, and the price gap closes. That mechanism restores balance. But in today's silver market, arbitrage is effectively dead. Not inefficient, not costly, dead. And there are 3 distinct reasons for that failure, each reinforcing the other. First, there is no silver in Shanghai to source and ship west. Shanghai is not swimming in excess supply, it's facing a shortage of its own. Silver in Shanghai is trading around $104 per ounce, while COMEX is near $91. A $13 premium that signals regional scarcity, not abundance. Chinese industrial buyers, solar manufacturers, electronics producers, EV battery makers are all competing for a very limited pool of silver. On top of that, China implemented export restrictions on January 1st. Once silver enters China, it cannot leave without an export license. And those licenses are not being granted. Silver inside China is effectively locked in. That means silver in China cannot be moved to New York. The arbitrage route is blocked. Second, even if silver could be sourced elsewhere, physical delivery takes too long. Moving 1,000-ounce bars from London or Dubai to New York typically takes 4 to 6 weeks under normal conditions, involving vault release, transport, customs, and verification. Even under ideal conditions, that process takes more than a month. But the February delivery window begins in about 10 days and ends 28 days later. There simply isn't enough time. Overseas metal cannot arrive fast enough to meet February delivery requirements. The timeline alone makes arbitrage impossible, regardless of price incentives. Third, the bullion banks that are short silver, the very players who would normally execute arbitrage, are frozen. They don't want to buy silver. Buying metal to deliver against short positions means crystallizing huge losses. A short sale at $60 covered at $91 represents a devastating per-ounce hit. Their hope is that prices fall so they can cover at lower levels. But prices aren't falling. They're climbing. As a result, the banks are doing nothing. No buying. No arbitrage. Just waiting and hoping for a reversal that isn't coming. And nothing is resolving the imbalance between demand and supply. Demand sits at 235 million ounces. Supply remains around 23 million ounces. The math no longer works, and the arbitrage mechanism that should repair the system is gone. So, what does this actually prove? What does it mean when 47000 contracts stand for delivery in a market that can deliver only a fraction? It means a line has been crossed. We are now dealing with two completely different markets. Market A is the paper market, the futures market, where silver trades around $91. This market exists for price exposure, speculation, and contract trading. But it's becoming obvious that these contracts are not truly backed by physical metal. They are paper claims, essentially wagers on price rather than ownership of silver itself. Market B is the physical market. This is where real silver is bought, sold, and delivered. And in this market, prices are dramatically higher. Shanghai is trading near $104 per ounce. India is around $132. U.S. retail silver eagles are selling for roughly $142. These are prices paid by buyers who want metal in hand, not paper promises. So which price reflects reality? The physical price does. The paper price is an illusion. It's a digital number created by traders exchanging contracts that, in most cases, were never meant to result in delivery. The fact that 47000 contracts stood for delivery today proves that this illusion is breaking down in real time. Those contracts represent buyers calling the exchange's bluff. They are effectively saying, "You sold me a contract that guarantees 5,000 ounces of silver. I want the silver. Deliver it." And the exchange is looking at its vaults and realizing the metal simply isn't there. This is what the collapse of a paper market actually looks like. When delivery cannot occur and promises cannot be honored, the contract itself loses value. That is exactly what is unfolding now. The paper-silver market is being exposed as a structure that issued far more claims than there is silver to support them, rolling obligations forward until suddenly those obligations are demanded. What makes today's situation even more shocking is what happened over the past 2 weeks. On January 1st, the exchange attempted to halt the silver rally by raising margin requirements by 15% and changing the margin formula to 9% of notional value, hoping to force leveraged traders to liquidate and push prices lower. For about 48 hours, it appeared to work. Silver dipped from $88 to $85. Margin calls went out. Some traders exited positions. Pressure built. But then the market turned. Buyers stepped back in aggressively because the buyers standing for delivery are not over-leveraged speculators. They are cash buyers, institutions, and industrial users. They are fully funded and unaffected by margin hikes. They want physical metal and have the capital to pay for it. As a result, the margin hike failed. Prices rebounded to $91. Delivery demand surged to 47000 contracts, and every strategy to suppress price, reduce demand, and protect short positions failed, leaving a delivery crisis with no tools left. They've already used the margin weapon and it failed. So what comes next? A trading halt, force majeure, forced cash settlement, because the list of options is getting very short. And the banks sitting on the short side of those 47000 contracts are now in deep, deep trouble. Let me explain why today's data is a nightmare scenario and why they're effectively cornered. For years, the major bullion banks JP Morgan, HSBC, Scotiabank have maintained large net short positions in silver. This isn't speculation, it's documented fact. These are the institutions that sold the futures contracts now standing for delivery. And when you're short a futures contract, you are legally obligated to deliver the underlying metal if the long demands it. That means those banks now owe roughly 235 million ounces of physical silver to the buyers who stood for delivery. And they don't have it. Not remotely. Their entire strategy depended on the assumption that most longs would never ask for metal, that contracts would be rolled or cash settled, as they always had been, and that the system would behave normally. Today shattered that assumption. 47,000 contracts stood for delivery, about 47% of total open interest. Historically, that figure sits between 5 and 10%. Today's number was nearly 9 times the norm. That's not stress. That's not pressure. That's outright failure of the delivery model the system depends on. Now the banks face 2 equally disastrous options. Option 1 is to somehow acquire 235 million ounces of physical silver and deliver it. COMEX has only about 23 million ounces registered, leaving a 212 million ounce gap. Miners are sold forward. Refiners face long delays. Overseas sources are blocked, and private holders are not selling. Simply put, the metal cannot be sourced. Option 2 is declaring force majeure. This is the legal escape hatch, where the exchange admits delivery is impossible due to extraordinary circumstances. Contracts are forcibly cash settled at a price chosen by the exchange, and longs receive money instead of metal they were promised. But that option carries a nuclear consequence. Declaring force majeure would openly admit the paper silver market is not backed by real metal. Confidence would collapse instantly. Physical silver prices would explode, with Shanghai, India, and retail markets potentially gapping to $150, yuan, even $200. While trust in COMEX contracts is permanently destroyed, so the banks are trapped. Deliver silver they don't have or admit the system is broken and detonate the paper market. Either path leads to massive losses. Either path is catastrophic, and delay only makes it worse. Every day, more silver leaves COMEX, registered inventories shrink further, and time moves relentlessly against them. Yesterday, registered inventory stood at 23 million ounces. A week earlier, it was 27 million. It's draining fast. And once it reaches zero, the decision won't be optional anymore. Force majeure becomes unavoidable. To understand how serious this is, you have to look beyond silver itself, because silver isn't breaking in isolation. This is part of a much broader breakdown across global commodity markets and paper-based financial assets. Gold has just printed a new all-time high at $2, $644 per ounce. That's a 42% gain since the beginning of 2025. Gold doesn't move like that without reason. When gold goes vertical, it's sending a loud, unmistakable message. Confidence in fiat currency is collapsing. This is a global vote of no confidence in central banks and paper money. U.S. Treasury yields are surging at the same time. The 10-year Treasury yield hit 4.71% today, up sharply from 3.8% in December. Rising yields mean falling bond prices. Investors are dumping he says, government debt, because they no longer trust the dollar or the government's ability to manage and service its $36 trillion debt load. Capital is fleeing paper promises and rotating into hard assets. Equity markets are feeling the pressure. The S&P 500 is down 14% from its November peak. Technology stocks are taking heavy losses. Companies that rely on commodities, silver, copper, lithium, rare earths are facing exploding input costs, crushing margins, and increasing operational strain across entire sectors. Tesla has already announced a production halt due to silver shortages. Apple has delayed the iPhone 18 because key components aren't available. These aren't theories. These are real-world consequences. Commodity shortages are now directly undermining equity valuations, disrupting supply chains, and exposing how dependent modern economies are on materials that the paper markets assumed would always be available. Meanwhile, the Federal Reserve is cornered. They can't raise interest rates to defend the dollar without crashing the economy. They can't cut rates to stimulate growth without reigniting inflation. There is no winning move. They're stuck in Zugzwang, and the smart money understands this, which is why capital is repositioning aggressively. That's why gold is at $2. 640 Why silver trades at $104 in Shanghai, and why treasuries are being sold off aggressively. This is a systemic crisis, and the 47000 contracts standing for delivery today are just one visible symptom of a much deeper collapse in confidence across global paper markets and financial promises. Now look at India. Because India confirms this is a global physical shortage, not a localized exchange issue. India is the world's largest consumer of physical silver. Silver is woven into Indian culture used for jewelry, weddings, religious rituals, and long-term savings. And right now, the Indian silver market is in full-blown panic. Local prices in India have surged past 300,000 rupees per kilogram, roughly $136 per ounce. That's a $45 premium over paper prices. Even at that level, silver isn't available. Dealers are out of stock, refineries have stopped taking orders, and buyers would pay far more if metal existed. This is no longer about price. It's about availability. They're melting down gold jewelry to buy silver. They're taking out loans to buy silver. They're doing whatever it takes. Because Indians have thousands of years of lived experience with currency collapse. They understand exactly what happens when fiat money fails. They know the value of hard assets. And they refuse to be left holding paper when confidence breaks. That's why silver is trading at $136 per ounce in India. It's $104 in Shanghai. It's $142 for you. Retail coins. These are the real prices people actually pay when they need physical metal. And the massive gap between those prices and the COMEX paper price of $91 exposes the truth about the market. The paper market is a lie. COMEX may quote 91, but you cannot buy physical silver anywhere in the world for that price. Not in Asia, not in India, not in the U.S.'s. Retail market, not anywhere, which means $91 is not a real price. It's a fictional number attached to paper contracts that cannot be fulfilled. So, what does this mean for you right now? The next 30 days are likely to be chaotic. If you own physical silver bars, coins, or rounds in your possession, in a safe or in fully allocated storage, do not sell. Don't even consider it. You are holding the winning hand in a broken system. 47,000 contracts stood for delivery against only 23 million ounces available. A shortfall of 212 million ounces. This is the endgame for the paper market. Physical and paper prices are diverging permanently. The paper price may be pushed down, but physical silver is heading much higher, and you own the real asset. Hold it and protect it. If you own silver ETFs like SLV, you are exposed. SLV is custodied by JP Morgan, one of the largest short players. Today's data shows a 10-to-1 ratio of claims to metal. When pressure peaks, investors will be offered cash, not silver, at $91, while physical trades near $160. That loss is the cost of trusting paper. Don't hesitate. Sell SLV, take the cash, and convert it into physical metal this week. If you're holding COMEX silver futures with the intention of taking delivery, you need to hear this clearly. You may never receive your silver. Today's data shows COMEX is short roughly 212 million ounces. They simply cannot deliver, leaving force majeure or emergency cash settlement as the only outcomes. You expected 5,000 ounces of silver. Instead, you'll likely receive a check for about $455,000, calculated as 5,000 ounces multiplied by $91. But on the day they cash settle you, physical silver could be trading at $120. Your metal should have been worth $600,000. That $145,000 difference is gone. And the contract allows it. So if you're holding COMEX futures for physical delivery, the decision has to be made now. Do you close the position, take the cash, and buy physical silver from a dealer? Or do you risk being cash settled at $91 while real silver trades far higher? Exit the futures. Secure physical metal and act before force majeure freezes contracts. If you don't own silver yet and you're considering buying, the real question isn't whether you should buy. It's whether there is still any silver left to buy. The physical market is vanishing. COMEX confirmed they don't have the metal. And tens of thousands of futures holders will soon rush into retail markets. Those buyers will call every major dealer and clear out remaining inventory. Dealers are already depleted or charging extreme premiums. The U.S. Mint has stopped selling silver eagles. Retail supply is razor thin. And now disappointed futures holders are about to pile into the physical market. You need to act immediately. Buy what's available. And secure ounces now. Everyone wants to know what happens next. So let's talk about timing. I can't predict the future. But based on today's numbers and past precedents, here's what the next 7 days likely look like. First, COMEX will scramble for time by pressuring holders of eligible inventory to convert it to registered silver. They'll offer incentives, perhaps paying above spot to make silver deliverable. A few holders may agree, adding maybe 10 to 15 million ounces and pushing registered inventory higher, but against 235 million ounces demanded, they would still be short nearly 200 million ounces. The fundamental imbalance would remain completely unresolved. Around January 22nd, expect a carefully worded statement citing exceptional demand and supply constraints while reviewing settlement measures. Markets will react immediately. Paper silver could spike overnight, and global physical prices would jump. Then, near January 30th, an announcement would suspend physical delivery and impose forced cash settlement for February, officially cracking the paper market. That is force majeure. That is the moment the paper market collapses. And when it does, the physical market will detonate. Shanghai will gap to $130. India will jump to $160. U.S. Retail silver will be completely sold out. You won't be able to buy even a single ounce at any price. At the same time, the COMEX paper price will implode as confidence disappears. COMEX silver will fall from $91 to $75 or even $60 because everyone will finally understand that COMEX silver is not real silver. It's nothing more than a cash-settled wager. Demand for it will vanish. The premium on physical over paper will blow out to $40. 50 yuan, even $60. Two separate markets will exist. Hold physical and you win. Hold paper and you lose. That's the timeline. About 7 days of frantic scrambling. Roughly 10 days of carefully worded warning statements. Around 30 days until force majeure. And then a permanent split between paper silver and physical silver. The convergence myth ends, and the market accepts what physical buyers already know. Paper prices cannot dictate reality once delivery fails. Here is the final data point that confirms this is the end. The 47000 contracts that stood for delivery today represent 47% of the open interest in the February contract. Historically, only 5 to 10% stand. Today's figure is roughly 9 times normal. Smart money is front-running force majeure and demanding metal before the system breaks. This is a bank run. A bank lends out about 90% of deposits and keeps 10% in reserve. Under normal conditions, withdrawals are small and manageable. But if too many depositors demand funds at once, the bank cannot pay. That is exactly what happens when confidence breaks and claims exceed available reserves. Today was a COMEX bank run. 47% of contract holders showed up demanding silver. The exchange only has about 10% of the metal required. Delivery is impossible. The run has begun. And bank runs do not stop, they accelerate. Next month, even more contracts will stand until delivery is shut down entirely. This is not a temporary squeeze or a momentary supply issue. This is structural failure. The exchange sold more claims on silver than silver actually exists. It operated a fractional reserve commodity system. Today, the claim holders showed up. The vault was empty. That is the end of the game for paper silver credibility. The 47000 contracts standing for delivery are proof, mathematical proof, that the exchange cannot back the contracts it sold. Proof that physical silver is in severe shortage. Proof that banks are trapped with no viable escape. And proof this is the last opportunity to move out of paper and into physical before collapse becomes official. Do not wait for mainstream media confirmation or official announcements. By then it will already be over. Physical silver will be unavailable. Paper contracts will be worthless. This is Friday, January 16th. Downsinling Richelieu. The ratio is 10 to 1. The system is failing. Decide now physical metal or paper promises. Exit paper. Secure physical. Do it immediately.